So, today we're going to talk about something that has been on everyone's mind lately, and that is inflation. Specifically, what do you need to be doing in your financial plan, in your portfolio, to make sure that you cruise through this inflationary period that's coming up soon? With the consumer price index inflation coming up at 7.5%. That is the highest we have seen in probably about 40 years or so. We saw cost of living adjustments make a healthy reappearance. The White House is talking about potentially having a 4.5, slightly above percent increase to federal employee salaries for next year, which sounds like it might be a really great thing, but there's a reason that this raise might not really be as exciting as everyone is making out to be. Cost of living adjustments are set based off of what the expected inflation is going to be in the upcoming near future. So inflation begins to erode the purchasing power of your cash, of your salaries, of your portfolios. And so when we see cost of living adjustments, that's really just an effort to keep up with the rising costs of everything around us. Now, too much inflation makes it really difficult for wages, salaries, and your portfolio to keep up with the rising costs of everything around us. Inflation generally tends to come at the tail end of a really strong economy. If you think about last year, the markets were absolutely booming, and despite all of the craziness with the pandemic, a lot of companies were still doing very well. Now, naturally, when we see inflation, the market will react. The Federal Reserve, which is the organization that monitors monetary policy, they control the flow of money in a lot of ways, very simplistically, right? They do something called quantitative tapering.
Quantitative tapering, known as QT, is when the Federal Reserve is taking their foot off the accelerator in an effort to slow down the economy. Various forms of economic stimulus, or QE, were provided since the beginning of the pandemic, leading to a growing economy and higher inflation. The balance between QE and QT is like trying to balance a seesaw equally on both sides. The Fed now has a nearly impossible job of pumping the brakes without completely screeching to a stop.
The yield curve shows the different interest rates that investors are demanding as a return in order for lending their monies for a certain period of time. So simply put, the yield curve tells us a little bit about what the sentiment is of the overall stock market and how investors are feeling about what's to come. So economists and financial planners like ourselves will look at the shape of the yield curve. If we have flattening yield curves or even inverted yield curves, that tends to give us signs that we may see some rough times in the market, okay? If a yield curve is too inverted, that typically follows with a recession, okay? That's not what I'm forecasting here because, in fact, we have a lot of really strong indicators showing that the overall economy is still doing okay. But inflation has started to come back, and we're starting to see the Fed react accordingly. So how are you to deal with an inflationary environment, especially if we start to have a little bit of a recession? Inflation causes all kinds of things to happen to interest rates. Interest rates increasing means that your bonds are going to suffer. And so for someone who potentially is retiring soon, or maybe you're already retired, this is a really important factor that you need to consider in your overall plan. One of the things we see very hand in hand with inflation is a volatile market. So not only are prices going up, but the markets are also becoming volatile. So you're having to pay more for things and you're having to draw from a portfolio that is moving more. That can cause a lot of stress in your portfolio if it's not set up in the right way. Now, just to clear the air, we know that the volatility that comes in the market is not here to stay. Okay, we know that you have to be invested in equities for the long run because really there is a relentless upward trend in the overall stock market as it relates to equities and good, strong companies. But what that means is over a long time it's going to be fine, but in the short term, which is, by the way, when you need money from your portfolio, you really start to struggle in determining, well, if things are volatile in the short term and if bonds are really struggling, what are we going to do? And this brings us to the dilemma. If bonds are struggling in an inflationary environment, right, meaning they're not really providing you with the income that you need, what is a retiree going to do? Well, what they could do is they could shift some of their bond allocations that are not doing well and move them to stocks in an effort to kind of recuperate that growth. The problem with that is that at the same time, we're seeing a lot more market volatility. So if you're increasing your stock and equity positions, now you're also increasing the risk in your portfolio as well. And if we start to have a significant market drop, now you're having to draw against a portfolio that has dropped much more than it should have, and you can start running into problems down the line where your portfolio gets drawn down much faster than you would have anticipated. And at this point, if you're not working anymore, that could be a really big problem. So for investors, sometimes it feels like you're stuck between a rock and a hard place. What are you going to do? You can't look to your bonds to supply you with the income, because bonds or fixed income instruments usually provide you with that income that you need. But if bonds aren't doing well and you can't look to them for that, but you can't go to stocks either, because if you do that, you're overexposing your portfolio, you're creating unnecessary risk. What is an investor supposed to do? Enter the insurance agent. You know, if something is too good to be true, it generally is, right? In times like these, when markets become volatile, there are legions of financial professionals that begin to offer insurance investments, okay? And as a means to be able to offer you no downside risk while still being able to participate in the markets. Those are two very contradictory concepts, but nevertheless, they exist within certain insurance vehicles. And how do I know? Well, we get the phone calls from federal employees, and the phone calls usually go, well, Thiago, I received this investment proposal and I'm a little bit uncertain because, of course, it doesn't really make sense that you get to participate in a risky type of investment without actually acquiring any of that risk. Now, that's not to say that these programs are horrible. Okay, this is not a knock on insurance. Insurance products are an important part of a financial plan. They're an important part of a retirement plan. Life insurance is important, long-term care insurance is important, health insurance is important, FEHB. There's all kinds of things in the insurance realm that may be appropriate for you. But you have to understand, insurance is a tool. A tool is used for a specific job, okay? And you need to really be careful and analyze these investments carefully when they are combining insurance with investments. There's been very few times where we've looked at a circumstance and a federal employee who already has a guaranteed pension, who already has Social Security, which is technically guaranteed. We won't get into how it may go down, and that's not the point here. Subjecting your liquid capital to become illiquid and giving up that control for another form of guaranteed income just hasn't really made sense for our clients anyway. So just kind of keep that in mind. Okay, so let's get back to it. So if bonds are struggling and you can't go to stocks without overexposing yourself to growth, so what is an investor to do? Now, I hate that I can't just give you a straight up answer. In fact, the answer to this question is the answer I hate the most, which is it depends. Now, before you roll your eyes, okay, there is more. Not all stocks are created equally. There are growth stocks, there are value stocks, there are small cap, there's large cap, there's international, there's domestic, there's dividend paying. There's all kinds of different stocks out there, and they all behave a little bit differently. So when we're talking about creating a portfolio of 70% stocks, 30% bonds, you can have many different 70-30 portfolios, and they all behave very differently depending on what's going on in the underlying investments. Now, historically, during inflationary periods, we see other sectors really take a foothold, and namely, these are sectors like energy or financials or industrials, perhaps even some of the very short-term bonds, right? Because they are actually yielding higher. We already know you have to own equity because equity is on a relentless upward trend, and in order to meet your long-term goals, you have to be invested in long-term equities. But in this intermediary period between now and possibly even a few years, you really need to consider that you might have to reposition yourself in order to still be able to meet your income needs and continue to build your portfolio to the degree that's going to actually keep up with the inflation that is beginning to erode the purchase of everything else. Now, if you do make changes, please don't invest in the hot stock, the hot trend, what your neighbor said is cool, what your colleague said is working for them. Every investment plan needs to be tailored strategically to what your goals and timelines are. Specifically, something that is guided by an investment policy statement. An IPS is something that you construct and you put together to create alignment between your retirement plan and your portfolio. So there is not randomness. You are not simply picking some investments. And there's very strategic thought behind what kinds of stocks, what kinds of bonds, because those are the instruments that you're using to help you accomplish your retirement goals. On top of that, it's critical that you stress test your portfolio as well. What does that mean? Well, in markets that are bad, or let's say you have a year or 2 or 3 of high medical expenses or something else that comes up, you need to be able to know exactly how your portfolio is going to behave so that if that comes to be true, you know how to react and make changes accordingly. Now, the reality is that the Fed knows they can't put in too many hikes in the same year, because if they do that, they're going to cause a very extreme inverse in the yield curve, and that's going to spiral the economy out of control. That's not their job. Their job is not to create chaos. Their job is to create stability. So when they make some of these announcements, they expect that the market is going to react. How long the market reacts for is still yet to be determined, but that volatility in the market, the panic and the sell-offs that we see, that actually, in an essence, does the Fed's job for them, okay? So it's important that you do still have a strategy, even though everything might not be falling apart. The other silver lining is that we still have pretty good economic indicators. So yes, we are starting to get more volatility and inflation is coming back, but we're still in the golden period, if you will, okay? And this provides you with an opportune moment to take what you have while you still have some time and structure a plan around it, okay? The worst thing that you can do is to start planning when you're on fire. That's not helpful to your planners. That's not helpful to you. Flexibility is one of the absolute most important parts of a successful financial plan, and wealthy families know that they need to give themselves enough time, especially when things are good, to be able to get those plans in place so that when the going gets rough, you can just fall back to your plan. So I hope this was helpful to you. I know this is very short and sweet and to the point. Surviving an inflationary period requires a lot of strategy. It requires your being patient, and it requires, frankly, a little bit of ice in your veins, because it's going to get rough out there. So just make sure you have a good plan to fall back on and reduce that burden of uncertainty on your family, because after all, it's not really just your money, it's your future.